FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Today's show is brought to you by Blue Sky Uranium Corporation. Blue Sky has first mover advantage in Argentina in the world's newest uranium and vanadium district. With an existing near-surface deposit that's open for expansion, Blue Sky also controls a massive district-scale land package with mineralization along a 145-kilometer-long trend. Blue Sky possesses tremendous exploration upside and is an excellent leverage play on rising uranium and vanadium prices. The company is run by a best-in-class management and technical team with proven exploration and development success in Argentina. Blue Sky Uranium trades under the ticker symbol BSK on the Toronto Venture Exchange and as BKUCF on the OTC. For more information and to stay on top of the latest news, go to blueskyuranium.com. That's blueskyuranium.com.
The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 5/14/19. Hey, as always, be a part of the show. Email us, kl@kerrylutz.com. Well, we got a trade war, economic war, whatever you want to call it. It doesn't look all that great. I think it's a cause of concern to most of the thinking people in the world. Is this 1920s redux? Are we making the same mistakes we made then with the same outcome? Well, let's talk to Danielle Park and get her opinion on it. So Danielle, as always, welcome. So what do we make of this so-called trade war?
So a bunch of things. Historically, this is a very common scenario that's playing out right now. I think that's the first thing people should appreciate, and that the dynamics at play are something we've seen multiple times over the past couple of hundred years. I think that this period lines up with what was happening in the late 1920s on many levels. Not only are we in the midst or at the end of a gilded age, much like we had in the 20s. You had a major land boom in the early 20s, and then a massive leveraging boom and securitization boom that went on to Wall Street into the late 20s. And in the process, you also had the electrification of America in that time. So you had enormous productivity gains. But the problem at the end of the day was that the income of the average worker did not keep up with the gains in productivity. And so consumption began to falter. And that's very like what you're seeing today, where we've had, productivity gains in many things. But as we know, the working person's income or the average income has been very much flat for the past couple of decades. And we have in America an economy that's still about 70% driven by U.S. consumption, by household consumption. In Canada, it's more like 60%. But the same problem exists in that you're trying to continually drive the economy into a perpetual growth cycle with this flat line in consumption ability and the weight of debt for consumption that's gone before. And so the bottom line is that I think adding these tariffs, while completely understandable, and again, what we saw in the late 20s, this preoccupation with, well, how do we get more customers from abroad? Because when your demand at home is faltering, you think, okay, let's sell to more foreign customers. Makes perfect sense. But what they did was, with the Smoot-Hawley bill that came in, they added tariffs, and of course that was responded by tariffs from other trading partners. And although in the beginning, it seemed like imports were falling, and you were going to get some net benefit to American GDP, at the same time, of course, exports fell by almost the exact same amount. And so, at the end of the day, although it looked like they were doing something, they weren't addressing this problem of the massive income disparity and the stagnation of wages that had happened over the preceding couple of decades, and the concentration of wealth in the very, very, very wealthy in that society at that time. And so at the end of it, When Hoover signed it into law, lots of politicians on both sides of the aisle were begging him to veto it, to not endorse this bill that had been proposed, because again, that wasn't the first time we'd seen proposals for tariffs and the zero-sum game that happened in past cycles as well, even before the 1920s. But at the end of it, by 1934, world trade had fallen about 66%, right, from 29 to 34, because of the reciprocal tariffs and the reciprocal, again, driving up the cost of goods only means less consumption in the end for incomes that remain flat. And I think that's ultimately the problem here. So I don't think it's going to help anything, if China responds by trying to sell treasuries and things. Maybe you'll see a weakening of the U.S. dollar, which theoretically could help the multinationals some more. But multinationals, as you know, Carrie, have already had a hell of a run here, record profitability for more than a decade, and that's really not helping where the bind is here. The bind is in the household and in the flat wages, and that's not likely to be remedied in anything that's happening at the moment.
Yeah, and that's been exacerbated by taking on more debt to make up for the income deficiency. That was never the purpose of debt in the past. It was to finance larger purchases like a home, later on automobiles, things like that, not to artificially inflate your standard of living.
Absolutely, and just eating out and like all the things that have transpired in this. In the waves that have come through the economy, where people are, working lots of hours, not necessarily getting any more free time or any more net income or savings out of the process, because they're consuming so much of what they're earning and because they're paying so much in interest payments. So it's pretty fascinating. I certainly think that China has more to lose than the U.S. does, just because they are so dependent on exports. And 18% of U.S. Of the U.S. buys 18% of China's exports at this point, and 21% if you if you include Canada. In other words, North America buying of these exports. And of course, what America sells to China is minuscule relative to that, and that therein lies the actual issue that they're trying to force China to consume more American goods. But as I pointed out on the blog this week, of course, the other problem there is back to who's got the spending capacity, and China is very much still their household income is something around $16,000 on average, relative to the U.S. around $58,000 on average. So the relative buying power of their households is just, a third of what the U.S. and Canada is. So again, their household consumption drives just 39% of their national GDP. If they lose this chunk of exports, if it suffers this 18% of their GDP they sell to America, if they lose a good deal of that, they don't have a lot more to take up that slack. And their households have less stored wealth or seed corn even than we do in North America, even though households here are fairly emaciated at this stage in this late credit cycle. So you really, it's how to get more consumption, and that requires a transfer of income in various ways into the general population to help them pay down debt, build up savings, and have more consumption ability. And again, that's not something you can fix by any sort of quick edict from any government. But I think in this case, perhaps it's a very, the hope is, the big risk for the Trump administration, of course, is that the economic cycle is weakening. Well, he had a high probability of that happening, given that they came into power very late in this cycle, as you well know. Mm-hmm. So the probability of them facing a downturn was very high in their first term. And indeed, it's happening. And so, as that continues, they're going to look for a foreign scapegoat. This is classic, right? How do we divert the attention of the populace who are going to be unhappy with the amount of progress that any government's been able to achieve in these conditions on a short-term window? And how do they divert that attention to a foreign enemy? And I think that that's probably why they're going for this strategy right now, even though it's proving to be a threat to the stock market bubble that Mr. Trump's been so proud to point to as the really leading signal of his success. Yeah, so it's a complex time, but if you understand history and what's driving it at a fundamental basis, then it's actually pretty simple and pretty predictable almost in the ways in which it'll probably move going forward.
Yeah, no doubt. Well, history always repeats itself. And the Hoot-Smalley Tariff Act in the 20s there is largely credited for exacerbating the Great Depression. I mean, there were a lot of other things involved, a lot of other factors, but that was kind of like the straw that broke the camel's back, I guess. It was
Yeah, I
interest
think
rates.
the consensus of economists is, it's hard to get economists to have a consensus, but they do seem to agree that it was the knockoff, the tit for tat, that really accelerated the downturn that had already begun, and for many of the same reasons, because we had a massive spending bulge in the 20s, and too much leverage and risk taking, too much debt, to concentration of wealth in asset owners versus workers. And so those sort of the dynamite that was, building up there is very similar to what we've seen in the last little while. So I think it's interesting, though. Milton Friedman, the monetary economist, he didn't think that the trade tariffs had much to do with the onset of the making of the depression worse. He argued that it was monetary forces, right? His whole ideology is that all these things are monetary phenomenons. And to some extent, I would say it's just what I just summarized, that I agree with him that those loose monetary conditions and lax oversight of the banking sector were huge catalyst for the onset of the Depression. And it was really that final bursting of the asset bubble that brought on the most of the difficulties. But having said that, again, very like today, politicians looking for scapegoats other than that the system has enabled too many debt bubbles and asset bubbles. They look for this other excuse or way out other than allowing the weight of those things to crush the owners and to have this redistribution of income and wealth in the economy. They would rather try and blame someone else and get someone else to buy goods, even though when you look around, you see that the consumption ability of households in China is even less than the households in North America.
And they save way more of their income, like 40%, because there is no safety net there. Like, you don't save, you lose your job, or something happens, you don't eat. We always go back to this measure, the Baltic Dry Goods Index, because it's such a great predictor of what's going to happen. We saw it in late January, early February, literally crash to like 600. And then it's gone back up. It's just over 1,000 right now. But this index, you look at that chart, if it was a stock, it's a very ugly chart. You've got lower highs and lower lows. And again, that's also impacted, Carrie, as you know, by the massive overbuild that went on in the last 15 years, because of all the securitization and free money flowing through the world, because of the hyper consumption that was enabled by this, starting from sort of the mid 2000s. You had this sort of massive overbuild in transportation and freight tankers and all that stuff. And so now the amount of, as we're in this secular decline in consumption for a while now, for the past few years, demographics, debt, all the reasons we're talking about, you're going to see more and more superfluous transportation vessels. And that, of course, lowers so many people looking to carry goods and much less goods, lowers the cost or the freight that can be charged. And that all impacts that index as well. Yeah. Plus, we had the expansion of the Panama Canal, which led to a lot more capacity because you had these Panamex, I think they're called Panamex ships, that go much larger, go through the canals. They were limited the size of the ship they could get with the old canal. I was there in Panama when they were just getting ready to open the expanded canal. And it's an amazing thing to watch the ships go through that canal. It really is. You just watch it and it's like ballet. But that helped increase capacity as well. But it looks like, utilization is like way down. So I guess there's going to be some consolidation in this sector. Like everything else, there's going to be a lot of boats getting scrapped because they'll always get rid of the marginal capacity first, right? The marginal older ones, less economic, higher cost per ton. Those are going to go, but eventually they cut into the newer production too. They mothball those ships. And There's kind of no getting away from it.
Yeah. So, again, you see the theme here, right? Is that this massive overbuild, and it's not something that's going to clear quickly. People look at just population on the planet and think, oh, well, because the population's growing, we're going to have this insatiable demand for consumption. But in reality, you have to look at the relative ability of that population to consume. And whenever you get, whether it's because you have a corrupt regime like in Venezuela, whether you have, a communist government like in China, where you've got huge graft and huge concentration of wealth in a very tiny fraction of the population, or whether you have it in a corporatocracy like America, where so much of the dramatic increase in spending ability has gone to a tiny fraction of the population, you leave behind the masses, and that is why you have these downturns. When the masses tried to keep up with the debt by taking debt, as you said at the start, by taking debt to keep up, and then they fell behind. Now you've got this big shift that has to happen again, where the debt that's held as assets by the very, elite part of the population start to lose their net worth or lose their assets value because of the popping of these bubbles. And then ultimately you have to have more stringent, no one likes to hear it, but you have to have more stringent tax policy in terms of flat taxes that force corporations to pay a larger share. So that there's this transfer, minimum wage things. I know no one likes to hear that, but you have to force a system like this does not just unilaterally start sharing more in order to get this multiplier effect through the economy. It just doesn't. It's geared to concentrate wealth in a very small percentage, which coming off of again, if you're coming out of a big period where labor has had the upper hand and unions have been huge and workers have been really getting a huge amount of their of the income gains, that pendulum then starts to swing the opposite way as well. It's just that right now we're at the end of this period where corporations have had it all their way and asset holders have had it all their way, and now we have to mean revert on some of that.
Yeah, well, one thing I'd like to point out what happens with minimum wage is it hurts the people it's most intended to help. We see it here in the U.S. in McDonald's, the fight for 15. Okay, and maybe McDonald's is paying $15 an hour now. In New York, they always paid way above the minimum wage because they couldn't get employees at minimum wage, but it's a market kind of thing. But now we see these nice, bright, shiny kiosks that have replaced the entire cashier department, if you will, the front desk, at the order desk at McDonald's. And we see restaurant employment in the United States for the first time in generations is actually declining. And, for the very same reasons why these people weren't getting paid enough in the first place. And really, you have to segment that between small businesses, pay what they can afford, larger businesses pay what they can get away with. But you see that minimum wage actually depresses overall employment. And I always give the example, Danielle, in Palm Beach County here, if you on Palm Beach Island and you get the minimum wage, even if they pay you 15, you can't afford to live. But if you go all the way to the other side of the county, the westernmost part, in a little town called Belle Glade, and you're making $15 an hour there, you're living maybe not high on the hog, but you've got a much better standard of living than somebody in the eastern part of the county. And that's why it's hard for government to mandate, to actually mandate what people should be paid. Believe me, on the other hand, I don't like to see companies like Amazon, their employees really not happy. They're being worked to the bone, really abused. And, they up their salary to $15 an hour, then they cut their hours. So how
and then
how
they
is that an
replace them with
improvement?
machines that are doing the boxing. But again, so we can't stand in the way of the automation of many of these things. That would be foolish to try and argue against, online selling, for example, the repurposing of malls into other properties because the customer is now exhausted and no longer spending, tons on credit in order to just keep up. So we have to accept that there is a natural wave here and that the consolidation of the retail sector has been long overdue, as an example, because it was so dramatically overbuilt in the credit bubble. So we have to accept that these things are naturally occurring, and we're not trying to stop that. But we also have to look at the extremes that have developed in the current situation, where you have companies like Amazon getting enormous concessions from taxpayers all over to come in and take over these warehouses. And as I was writing this week, if you look at it, you think on the first blush, I was reading about Amazon taking over some of these vacated mall properties, and you think, well, that sounds productive because they were empty. So, surely that's better. And then you realize, well, yes, except Amazon played a huge role in vacating them. Oh, well, that was our shopping reality. We chose to, or the consumer pulling in couldn't. That's all fine. But it's the investment from the taxpayer that if you look at what we funded in various places to establish these properties in the first place, to overbuild the retail sector, and now to provide ongoing services of every kind, sewer, water, emergency services. By some accounts, Amazon warehouses have emergency services there on a daily basis for injured workers, for example. Walmart has a disproportionate amount of conflicts and police called to attend.
Why is that? Especially in Florida.
So all this while they're paying next to no tax thanks to giveaways, gifts, and loopholes. And you realize, okay, fine. There needs to be a minimum alternative tax level where you say, fine, if you're going to be there operating, you have to pay at least X percent of your, sales or something, because otherwise we can't sustain it. This is how we've got all these deficits and debt on the public side, and how we've got people like Mr. Bezos as, more than 100 billion in net worth. I mean, at some point, if we don't try and share or redistribute some of these resources, we're going to have just a bankrupt situation everywhere you look.
And, to some extent, I totally agree with you. Bestowing public favors upon private entities, regardless whether they're making electric cars or anything else, should be outlawed. And they shouldn't be able to compete, like New York wanting to give Amazon $3 billion to move their East Coast headquarters to New York City. All right. Because, like these giga battery factories that Panasonic and Tesla were going to have tens of thousands of jobs. It hasn't worked out that way, and it never does. Government is always the accommodating loser. They're always happy to lose money in the hope of the public good happening. So let's just get them out of it. The rest of us will pay less. And one thing about the new tax law, and it's a little bit crazy because what it's enabled Amazon to do and so many other companies pay no income tax, but because of the bonus depreciation aspects of the law, which says that for anything that isn't a fixed structure or land, you could write it off instantly, whether it's new or used, new or pre-owned. So as a result, all of these companies, any company that's an expanding situation and is making large CapEx, basically gets to do it for free. Whereas,
and I think, at the municipal level, which is where much of this necessity and services are provided, roads and all the good stuff that we absolutely essentially need, whether you're individuals or whether you're a company, that you should never be able to get out of land tax. Because land tax, if you're owning the property, this idea that you should gift 20 and 30 years of free land tax is nonsense. Because again, what is that doing? That's putting a future payment ahead for the company, but the taxpayer is funding the immediate outlays right off day one. So again, this is this deferring of the payback that has created all the huge debt. that we're currently holding. In the U.S., just even the federal government is looking at $1 trillion deficit going forward. Canada's in a huge deficit position. This is all over the world. So you have to really follow the money. And I'm a fan of less complexity. I'm a fan of level tax rates. I'm a fan of taking away the loopholes and just saying, look, guys, talk to the hand. I don't want to hear all your fancy arguments. It's a very clear and fair low rate of tax, but that is the minimum. And if you come up with all these other things that enable you to somehow skirt that, we don't care because the minimum is the minimum.
Hey, look at it this way. Department stores, they always say that shoplifters, or pilferage, employee theft, whatever, the consumer pays for it all in the form of higher prices. Well, you know what? These giveaways to corporations on the local, county, state level, country level are the same thing, because for every dollar less that gets taken in taxes from these companies, somebody's got to make up the difference. We're not even going to get into the waste, the corporate welfare, and everything else that also drives up the price of
and the mess they leave on the public purse to clean up, whether it's in increased sick care costs, whether it's in pollution. All these things have just been passed on to the public with no checks being written at all. And of course, that's another thing that's bankrupting the public purse right now.
Oh, for sure. Well, there's a lot of reasons, a lot of causes, but I agree with you that there should be a low tax rate for all of us. No loopholes, no nothing, just pay it and shut up. And for the most part, there'll be a lot more winners than losers, but the losers, there will be big losers, and they will be howling just like they are in California now. All of these, wealthy producers, actors, actresses from the current revamping of the tax code that cut the salt. But in any event, well, we're not going to solve it all today, Danielle, but in 2 weeks, we'll be back and we'll solve the rest of it. How's that sound?
Sounds good.
All right. Just make sure you go over to Danielle's site, jugglingdynamite.com. And Danielle is one of the best writers out there. It's actually literate. It's grammatically correct. It's easy to read. That's why I always appreciate it. And you don't need a PhD in economics or finance to get it. It's very clear. Danielle, you have the rare talent of being able to take extremely complex topics and make them very simple in writing. That's not easy to do.
Oh, you're very kind. Thanks, Carrie.
Well, it's true, Danielle. I mean, in your monthly newsletter that I get, really puts a nice focus and spin on things. So jugglingdynamite.com. Check out our site, Financial Survival Network. Email kl@carrielutz.com. Danielle, we'll talk to you in a couple of weeks.
Okay, Carrie.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.